The extreme volatility of the market recently and the concern of hyperinflation or even stagflation have put almost every investor on edge. Looking at the diminishing value of the account, it's understandable how one may feel extremely nervous or may even be devastated, especially for people who may have a big expense on the horizon, like a new baby, a wedding, or a new car, a new house, or even considering retiring in the next few years, but now may need to put that on hold with fading patience and a wavering confidence. If you keep your eyes glued to the screen watching CNBC or Bloomberg, it's possible that it may even make it worse because you may feel that no one really knows for sure what will happen in the future. And the bad news may turn into worse news. If the past few months or the past few years are to any degree indicative of the future, you may worry that the world could come to an end at any time due to a random event that you just have no control over. In times like this, it should be helpful to put things into a different perspective. In particular, we could look at the long-term historical behaviors of the market, and hopefully that will shed some light on how the future may turn out, at least statistically. Let's take a look at SPX monthly returns since 1950. That's including the second half of the last century and the first 2 decades of the 21st. We are looking at the monthly returns, but note as usual, we are looking at them on a linear scale. The SPX, the US Large Market Cap Index, is considered the most representative indicator of the US stock market and the bellwether of the US economy. In 1950, the adjusted SPX index was about 15, while most recently, it reaches as high as 4,800. That's about 300 times higher than 70 years ago, although it dropped by as much as 20% since then. Over this 70-year span, it didn't go up in a straight line, but rather it accelerated through time, at least if we look at it on a linear scale, where the graph is even showing negative values. The most obvious deviation from the long-term trend we can see from this way of visualization is that the growth was more rapid in the 1990s, followed by the burst of the dot-com bubble, which led to the bear market in the first few years of the early 2000s. The market recovered in the middle of the decade, but collapsed again during the subprime mortgage crisis. Since then, the market has been growing at an accelerated pace once again for well over 10 years. So if this growth keeps accelerating on the linear scale, we would expect it to go up in the next few years and outside of the range of the chart we're showing here. The accelerating growth on the linear scale shouldn't really surprise us. When we talk about the value of the stock market over the long term, most of the time we refer to relative returns. This year the SPX has grown 10%, next year we expect it to grow another 10%. We rarely consider the absolute linear values. Say, this year the SPX has increased by 200 points. Next year, we expect it to go up by another 300 points, etc. It's just how we believe economy or civilization works. It grows relatively to the prior period. So if over the long term, we expect it to grow a certain percentage every year, what it means is that we expect it to grow exponentially. If we want to perform a simple fitting or regression on SPX over this period, so we can understand this in a more quantitative fashion, we need to use a logarithmic regression model. However, without going into the math, we can simply plot the SPX on the logarithmic scale. What does SPX look like on a log scale? Well, it almost looks like a straight line going up and up. It's remarkable how perception changes with just a different way of plotting the exact same series of data. We can, in fact, just draw a straight line and show that it fits the long-term trend pretty well. Not perfectly, but reasonably well. In the 1950s and the 60s, the economy was good and the SPX was above this long-term trend line. In the 1970s, the economy began to wane, and in the late 1970s and the early 1980s, US economy experienced the famous hyperinflation period. Paul Volcker and the Fed had to invoke extreme quantitative tightening to curb the inflation. In the recession in this period, the national unemployment rate rose to over 10%. After that, the economy recovered and the market grew again steadily, especially in the second half of the 1980s. SPX grew back to the long-term trend line, so it was actually growing at a faster pace than the long-term average. The detailed growth history in these early periods, we wouldn't be able to see clearly directly on the linear scale without zooming in, because the absolute scale was too small compared to the level of thousands in the recent years, such as 4,800 as the recent high. The period after the Black Monday in 1987, the market continued to grow at the average steady pace until the second half of the 1990s. The explosion of the new internet technology led to the dot-com bubble. The growth speed during this period, as we can see clearly here, is a lot faster than a long-term average pace. The bubble eventually burst in 2000, and SPX fell back to this trend line before starting to grow at a steady pace again until the subprime mortgage crisis, which dragged SPX a lot lower than the long-term trend line. Since then, SPX has gone on an unbelievable bull run that we are all very familiar with, at a pace faster than the long-term average, reaching as high as 4,800 before starting to correct itself again this year in 2022. The growth pace in the last 13-14 years may not seem much faster than the average, but since the COVID crash in March 2020, we can see the growth is extraordinarily faster. Let's put this into a more quantitative perspective. Let's try to fit this growth with a logarithmic model, or in other words, a linear model on the logarithmic scale. So the middle line here is the best fit relationship. Not surprisingly, it's pretty close to the trend line we drew earlier. For clarity, let's just get rid of the trend line we drew by hand. Again, the middle line is the best fit relationship. The lines above and below represent the plus minus 1 sigma and the plus minus 2 sigma levels of the best fit. We can see it broke below the minus 2 sigma levels in 1979, then again in 1982, but not again until 2008. Those are the hyperinflation and the subprime mortgage financial crisis periods. On the bullish side, the tech boom in the late 1990s pushed SPX above the plus 2 sigma line before it corrected itself and retreated to the long-term trend line in the late 2002 and early 2003. Since then, the market recovered until 2007, followed by the crash in the financial crisis, which pulled the market hard to break below the minus 2 sigma level. The pace of the bull market between 2008 and 2015 is faster than the long-term average, while the continued bull run saw steady growth on par with the long-term average pace. You may find it interesting that the crash in March 2020 only saw the SPX down to the minus 1 sigma level in our simple long-term log model. Following that, the market was turbocharged by both the aggressive fiscal stimulus and extreme quantitative easing by the Fed in the United States and also globally. And the pace obviously was exceeding the long-term average. Now, with the inflation running rampant, with CPI as high as over 8%, and the market has seen as much as 20% downturn, what is going to happen moving forward? We can look at the history for periods with some degree of similarity for some clues, such as in the late 1960s and then 1970s. The optimistic scenario is that it may come back to the plus 1 sigma line and then keep growing for more years. While the less optimistic scenario is that it may only retreat to the long-term trend line. The most pessimistic scenario, however, is that it may keep dropping until it gets to the minus 2 sigma level. With these possible scenarios in mind, let's try to go back to the future and try to extend these best fit lines and project what these different scenarios may look like in the next 5 years and the next 25 years. Let's extend the best fit relationship to 5 years in the future, June 2027. Now let's extend the plus 1 sigma level to 5 years in the future, June 2027. And finally, we extend the minus 2 sigma level, the pessimistic scenario, also to 5 years in the future. If SPX lands on the long-term trend line in 5 years, we see it will be at about 5,000. In a more optimistic scenario, at a plus 1 sigma level, it will be at about 6,300. While if economy goes through a severe recession, as many people fear, and SPX drops to the minus 2 sigma level, we see it will arrive at approximately 2,800, maybe even a little bit lower. Okay, from 6,300, 5,000 to 2,800. That's the possible range we will see in the next 5 years, in the not so distant future. The pessimistic scenario of course, is a little bit scary. What about in the much longer term? What if our main concern is in 25 years, thinking about retirement, for example? Let's extend these lines to 25 years to the future and see what we get. That's June 2047. Let's extend the -2 sigma line as well, June 2047. And then also the +1 sigma line to June 2047. Let's move this out of the way. Okay, if we land on the long-term average, we see we have about 19,000. If we land on the +1 sigma level, we arrive at about 26,000. Even with the more pessimistic case, the -2 sigma level, we see SPX at a little over 11,000. That's still close to 3 times where we are. Alright, now with this new perspective, we can ask ourselves again, what should we do if we have a big expense on the horizon in the near future? If we are planning to buy a house, a car, or have a baby in the next 5 years, we probably should consider less risky assets than equity. Maybe even consider a savings account. On the other hand, if our main objective is positive investment returns over a very long term, 20, 30 years in the future, then we probably shouldn't worry too much about the market turmoil. That can be considered noise in the grand scheme of things. There is, however, of course, always the possibility, no matter how tiny, the market could just crash due to an unforeseen event. So it's important to keep things within context. And remember, no one really knows about the future. Okay, as usual, this is for educational purposes only, as investment and trading comes with an enormous risk. Talk to a financial advisor if you are considering serious investment. But hopefully this is useful, and I hope to see you again next time.